Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been and still is, I suppose after a fashion, the breach and now seemingly repaired dark blue September to December 2024 bear channel, currently 1692 to 1990. This pattern achieved its primary downside target mid-January and its secondary hard reach target about a week after the primary target. Interestingly, the move down to the secondary target and back up again formed another new pattern, one which I will discuss shortly. However, before that, I'd like to highlight again another larger, longer-term pattern, and that is the bright red November 23 to September 24 bearish shift pitch walk. We're close to the bright red middle time below, currently at 1765. I have another pattern which I would like to discuss and maybe another to think about, and that's the bright pink late September 24 to mid-January 25 bearish Andrews pitch walk, which I drew 5 weeks ago to try and make some sense of the recent moves. We are today close to the middle time below, currently at 1747. All these three indicates the market pushing lower, but that we have support below from about 1770 down to about 1680, though it is a declining support. Thus, last week's test lower and so far failure to properly exploit the move down to and through the interesting 21st century absolute Fibonacci line at 1809 is not an endorsement of the move lower as yet. Admittedly, prices did push down through the 50% Fibonacci on the April 20 to November 23 move at 1859, but prices have gotten somewhat bogged down at the 1809 level, though we are moving below that now today. And they got bogged down there back in early March, late January, and throughout most of July and August last year, so keep an eye on that. I once again went back to my monthly charts in a further effort to get a handle on what technicals were operating here. So the major pattern which I saw there and which is still working is the double top, an Adam and Eve type which had been constructed throughout 2023. Thus had already reached its primary target at 1880, but it still left alive the harder to reach secondary target down at 1630. This, as I've said for many weeks now, this longer term pattern is the one I choose to watch. And I'll see how it develops. However, it all depends if prices can break down through below the 1740 level and then to further exploit it on the downside. Ice Europe white sugar in London. And there continues to be three features to bear in mind here on this daily chart. The first is the obvious and broken, though maybe coming back towards being repaired, purple late September 24 to mid-February 25 descending expanding wedge pattern, currently at 521.80 to 385.30. This pattern has more than the requisite 5 touches and has been severely tested on the top side ever since late February, though enough that I will not call it a descending wedge pattern after February anymore, though I still keep an eye on extensions to it, especially the upper trend line. The break upwards in mid-March reached up as far as the February 2017 high at 565 even, and in the process raised a question. Is the action since February a form of bullish halfway hesitation or a double top or something else? Today I'm more inclined to look at it as a double top, and we are testing the neckline. We were testing the neckline last week, and today at the October 22 low at 514.5, and we're doing that not very far from that, doing that again this week. Even last week's close below this level did not manage to tempt the bears, though we have been having more lower highs as we see the purple upper trend line approach the 514.5 level and crossover on the downside in early May. So there's a window there that's going to try and still stay above it, but I don't know how long. All this negates and retires the topside potentials of a primary target at 650.10 and the secondary target up at 673.80. These were the targets I previously laid out for a break up and out of the descending, expanding wedge pattern and are now retired, as I threatened to do last week. I'll instead now look at the downside, and whilst it's too early to give targets below, I can describe some potentials on the downside if we exploit this idea of a double top pattern idea. Hence, a primary potential will be down in the 492 area, whilst a secondary potential will be down at the 464 even area. This all very much depends on a true and significant break of the neckline area, something we haven't seen as yet. Additionally, I'd also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch hawk. We're right now between the overhead upper time currently at 560.90 and the middle time below currently at 502.60. This is a very shallow pitch hawk, and the more the market moves lower through it, the more I'm beginning to like it. Sugar white premium spread. A weekly key reversal up last week, but also a weekly indecisive doji cross, though it was the highest close since mid-July last year. This follows on from the previous week's bullish hammer pattern. However, the market was still bracketed by the familiar gold 1 year moving average below, currently at 108 even though this has been heading lower, and on the top side by the twin significant combination of 50% Fibonacci lines of the July 2019 to September 2022 move at 128.75 and the August 21 to September 22 move up at 131.25, plus the June 2020 high just above at 134.25. Overall, we can start to see the action over the recent weeks as a halt in the break up and out was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. We have now been hesitating for 8 weeks between the gold long moving average below to the overhead 50% Fibonacci line, the first of which is at 128.75. I raised the question last week, and I quote, "Is this enough to start talking about a possible bullish halfway hesitation from the start of the year, or also topping action?" At the moment, I still favour the idea of a possible bullish halfway hesitation, but can now start to see the merits of a topping action. Hence, I will retire off today from the original large descending wedge pattern seen throughout 2024. End of quote. You see, there was and is a very large question mark hovering over all of this due to the overhead combination of the previously mentioned 50% Fibonacci lines plus the June 2020 high, and a congestion area we have overhead between 128.75 all the way up to 153 even, which has made the idea of topside targets originally pretty hard, but now no longer viable. As for today, well, as I said last week, and also now for 5 weeks, and I quote, "The market has not taken the bullish incentive by the horns." Sorry for the mixed metaphor there. "We've not pushed just that far high enough as yet." End of quote. I also pointed out 5 weeks ago, and I quote, "Apart from the gold long moving average, we really don't have that much below until we start approaching the 85 even zone." End of quote. Nothing seems to have changed on this.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.